Are Dave Ramsey and Susie Ormond wrong about infinite banking? Could it be? Dave Ramsey and Susie Ormond have huge followings. They are celebrity financial advisors. They preach the value of cash flow principles and investing. They are quite knowledgeable in their field, or what in Hawaiian is called their kuleana. Kuleana translates route of travel. In other words, the area you are familiar with. Life insurance is certainly well within the area of finance. So you might assume that such financial pundits as the famous Dave Ramsey and Susie Ormond would know life insurance as they know investing and are qualified to advise on it. But here's a slice of reality for you. I am, in fact, a life insurance advisor and counselor. I'm also a broker. My kuleana is in the financial industry, but I am not an investment advisor. Well, other than my personal advice about investing is that investing in the stock market has zero guarantees other than the money one invests in stocks is at risk of total loss. And that's a fact. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. To my point about expertise in one area of finance, that expertise does not necessarily translate into expertise in other areas of finance. As I mentioned earlier, I am an expert on life insurance, but I am not an expert on securities. I will not venture to advise on securities and investments of that sort. But I am qualified to speak on various aspects of life insurance. So in this video, I'm going to address the problems and objections that Dave Ramsey and Susie Ormond have gone on record with in their attempt to discredit infinite banking. And if you find this information helpful, please hit the like button for this video and subscribe to this channel. Now, Dave and Susie are fond of saying that whole life insurance is a poor investment because the internal rate of return is so poor. They offer the suggestion that we would all be better off to buy term insurance and invest the difference in the stock market. They claim that it's reasonable to expect a return on investment in the stock market via mutual funds and so forth of 8 to 12%. So let's look at those claims. First of all, life insurance, even cash value life insurance, which whole life is not an investment as per the legal definition of investment. The legal definition of investment may surprise you. It includes, of course, the hope of profitable return. It also includes the idea that the investment may have a return of no profit or may result in loss. In other words, risk. With whole life, there is zero risk of loss of investment. As long as the owner, payer of the policy meets the required premium obligation, the policy will receive a guaranteed cash value throughout the life of the policy. And upon the death of the insured, the policy is guaranteed to pay out a minimum of 2.5% or 2.5 times the total amount of premiums that were paid in. By far, in most cases, the policy will pay out several times the total of premiums paid in. And that payout is exempt from taxes. On the other hand, term life insurance has zero cash value, and only 2% of all term policies ever pay out a death benefit. In most cases, they terminate before the insured dies, and then the cost to replace the policy becomes prohibitive. Bottom line is, whole life insurance is of incomparatively greater value than term insurance. As for the claim that investments in the stock market can be expected to return between 8 and 12%, again, that's not my area of expertise, but according to many reports readily available on the internet by reputable publications, the average return to investors in the stock market is 4.5%. And then, of course, there are taxes to be paid. So where they get their expectation of 8 to 12% returns, I haven't got a clue. Now, as to the internal rate of return, Dave and Susie like to highlight that whole life insurance grows cash value very slowly, and that the cash value is far outpaced by the premiums paid for the insurance. It is a fact that cash value of whole life insurance is typically zero for the first year or two, and then it begins to grow slowly for the next few years. And typically it takes about 13 years for the cash value of a policy to equal the total of premiums paid in. Then the cash value snowballs as it grows with compounding interest. So even though whole life grows cash value slowly at first, it is guaranteed, and there's no risk of losing all the money you put into it. And this is a very important point. While you can use the infinite banking strategy with pure whole life, a policy that is designed for infinite banking is constructed with riders that contribute greatly to the cash value accumulation. So while pure whole life has no cash value the first year, a policy properly designed for infinite banking will produce cash value in the first year equal to at least 60% of the premium paid. And that brings us to another of Dave and Susie's complaints about infinite banking, that the agents who sell infinite banking policies are padding their pockets, reaping huge commissions from selling the concept. Undoubtedly, there are unscrupulous agents who will sell the wrong policy for infinite banking strategy, and as a result, will collect an outsized commission. In fact, I know that is the case because I know of some agents who insist that a universal life insurance is ideal for infinite banking. Nothing could be further from the truth. Well, except if someone were to say term insurance is good for infinite banking, that would be indeed further from the truth, but I can't imagine anyone ever claiming that. The reason they like to sell universal life is because the commissions on universal life policies are crazy high. Many agencies pay their agents up to 150% of the first year's premium as commissions for universal policies. Thing is, universal life is absolutely not suited for infinite banking. I won't go into the reasons for that here because we have another video on this channel that goes into that. Well, by comparison, whole life policies pay commissions equal to just 50 or 55% of the first year's premiums, a far cry from 150% as universal life policies pay. And by the way, term policies generally pay 100% of the first year's premium. Now, when a whole life policy is designed for infinite banking, as I mentioned earlier, it is constructed with riders that make major contributions to the cash value of the policy. And those riders pay out only 2% of the first year's premium. The design incorporates the smallest portion of whole life as possible in relation to the total, including the cash value contributing riders. That means that while straight whole life policy with no riders may pay a commission of $2,000, let's say, a policy with the same total death benefit and for the same person, so same circumstances, but designed for infinite banking will pay a commission of just $600. So rather than padding their pockets with huge commissions for selling infinite banking policies, as Dave and Susie claim, agents who help clients with infinite banking policies that are properly designed actually sacrifice up to 75% of their potential commissions to do so. Now, I'm not one to talk bad of others, but I will say that the facts about infinite banking in particular and whole life in general show that Dave and Susie really are not experts in life insurance. In fact, it would appear that they really don't know much about life insurance at all. Dave and Susie do offer some good advice, just not so much with regard to life insurance. And they don't know what they're talking about when it comes to infinite banking. Again, if you have found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. Link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, we'd love to have you. The link to the application is also below. We're here to help, and we look forward to helping you. So for now, aloha and mahalo for watching.